You're listening to the Savings Tip Jar with Don Beatty and Denise Raywood, brought to you by Savings.com.au, your home of savings news, guides, and product comparisons. G'day, how you doing? Great to have your fiscally focused ears for another episode of the Savings Tip Jar, episode 153. I'm Don Beatty, the editor of Savings.com.au, alongside our senior finance journo, Denise Raywood, to once again help break down the week's main money matters, including the opposition's federal budget reply, which proposed something that I'd actually asked Angus Taylor about early last year, tax bracket indexation. Can't wait to discuss that. Plus, some more savings account rate changes in response to the RBA's hike and how, once again, big banks are failing to pass it on in full to savings account customers. And finally, how the latest RBA minutes have reduced the odds of another RBA rate hike at next month's meeting. After that, we'll talk to federal independent MP Nicolette Boele, who has some serious concerns about how the capital gains tax reforms will impact younger savers and investors. Don't miss that chat. And as always, we'll each share some savings tips. So, hello Denise, another jam-packed episode of Money Madness as usual. How are you?
Very good. Keen to get into the savings tips, Dom. I'm always interested to hear what you have to say for those, because it's getting harder to come up with savings tips when you have to do them every week.
Yeah, no, it is hard, but I feel like you kind of get used to it. You start thinking about, okay, what's my savings tip going to be throughout the weekend? And, I feel like you are getting a bit, maybe, I don't want to speak on your behalf, but do you think maybe you are finding it a bit easier to come up with tips each week to week than when you first started co-hosting this podcast?
You are speaking for me. No, I find them very difficult. I've always done them before.
Well, I don't know. I just feel like, you seem to always have a tip ready now, whereas before you're like, I don't know, I just couldn't think of any. But anyway, I'll start off with mine then, since you're so keen to hear it. This one is a bit of an old one that plenty of people would probably know about, but some of you that listeners might not. If you're doing some online shopping, sign in or create an account with the retailer you're shopping with, and then leave items in the basket without checking out, because within a few days you'll probably get some emails from them offering you further discounts to get that sale over the line. I actually tested this one out quite recently, just with some clothes that I was shopping for, and sure enough, they offered me a further 10% off the next day, just in the email inbox. They sent through a special code to use. So it does work. Not everyone will do it, but worth a shot next time you're shopping for something, and maybe you have the benefit of time to wait for that item. Maybe leave it a few days in the basket, the online basket, and they might be begging you to check out that sale and by giving you a discount. So have you ever tried that one, Denise?
No, a good tip though. I haven't actually ever done that. I'm not a big online shopper. I'm just a bit
no, me
distrustful.
either. This is actually the first time I've tried that.
Yeah, a few bad experiences, and I just think, I'll stick to the op shops. And okay, it's good to know that it works. Good tip. My tip this week, and it's because I've been doing since the rate hike. That was back on the 5th of May. It seems a long time ago now. We've had the federal budget since then. Every day I go scouting around to see which banks have moved their savings rates, and we're starting to get the last of those coming through. So it's put me in the frame of mind of that. And, I have noticed that there's some banks that just haven't passed on any savings account rates hikes as yet, and probably won't, given that it is the third consecutive interest rate hike this year. Maybe they've got a bit of increased fatigue. Maybe they think their rates are competitive enough. Or maybe there's been a bit of a drop-off in home lending, as we discussed last week with the lending indicators coming out. So maybe they're thinking they'll offset a bit of that upcoming loss with not raising their savings account rates. But a really good savings tip I would recommend it after every rate hike, is just check to see what the best savings account rates are on the market. The best ones are usually youth accounts, and I think I I checked a couple of days. One came into effect today that was 5.75, and there's a couple of youth accounts offering that rate. For those of us that are perhaps over 25 or 35 or whatever the general age is, you should just definitely be getting, sort of easy 5% on your money now. And when I say easy, no conditions attached. So if you're not getting that, it's a really simple way to save. Just change your savings account product. It's not hard to do. It's usually online, and you don't have to do much more. The interest rate should roll into you, and it's just an easy way to put money in your pocket. Just keep a check on it.
Mm-hmm. Yeah, for sure. Yeah, it is. I mean, obviously, we're going to be talking some more about, some of the savings account rate changes we've seen from banks in the wake of the RBA, and they'll be in our news section, which is coming right up. But yeah, even just generally, like, it's kind of crazy to think that just the average savings account, even the ones that you don't have to really jump through hoops for, it could be offering over 5%, because I think that's sort of the typical return you might expect from, say, like an index fund like the ASX 200. Yeah. Like if I'm getting at least 5%, I think, okay, it's not spectacular, but that's okay. And I just wonder if that's got to be a real disincentive for people to be investing right now and just be putting it in savings accounts, because, yeah, I mean, it's pretty much a sure thing when it's in a savings account that you're going to get that decent return of,
it is a thing. It is a thing, Dom. I mean, that's how I lost my job at the Motley Fool. Interest rates went up and mum and dad investors thought, why am I taking risks in shares when I can just whack my money in savings accounts or term deposits? There's definitely movement out of the share market when interest rates go high. It's sort of a no-brainer. Why wouldn't you do that? It's just a simple way. And, of course, there's always tax to pay on any interest that you earn, but it's just something that's very easy to do. You know what you're getting and you don't have to think about it again. It's pretty good return.
Yeah. I do wonder in a way if this will drive people towards a riskier investing in order to chase those returns that are far beyond what you can get in a savings account. To chase that 20% return, which is like usually really, really good. But for that, you usually need to invest in those more speculative stocks and not so much the large caps. Although that said, some of the big banks have had some pretty big growth in the past year or so. If you look at, what is it? I'll just have a quick look now in real time. ANZ, that's up 22% over the past 12 months. So that just goes to show that you can often get some bigger returns, even with some big stocks. But I probably shouldn't have said often, because that is quite unusual. But yeah, it's I just can't blame people if they want to, if they don't really want to invest and just want to keep the money in a savings account at the moment, given you can get over 5% without any conditions. So yeah, interesting to see. But yeah, without further ado, let's get into the news for this week. We'll start off with the big one over the past week, certainly, Denise, which was the federal government's the federal shadow government, what are they called, the opposition, have announced their budget in reply. Yeah,
that was interesting. It's something that you don't hear very many people propose, except perhaps those in opposition, and that is vowing to index Australia's income tax brackets if the coalition was to form a government. Now, the last time this has happened in Australia was in 1976. So you can see how rare that has been 50 years ago. And the reason, now, basically for those that don't quite understand, is indexing income tax brackets to inflation, the same way that wages can be indexed to inflation. It seems simple, it seems fair that you would also move the goalposts of tax brackets with inflation. Well, that doesn't happen. It makes governments billions and billions of dollars a year. Basically, any wage increase that you get will just get taxed at a higher rate. It'll tip you over into a higher tax bracket sometimes when there's your next wage increase. So your wages going up but the goalposts of income tax brackets don't, and it effectively sees you pay more tax. So, yes, Angus Taylor stood up in Parliament and said the government, if his party forms government or the coalition does, they will change that. And that is, probably not a great move for governments. It's just a free flow of budgetary funds and government revenue to leave tax brackets where they are. What do you think of that one, Dom?
Yeah, well, before I get into what I think about that one, I think it's worth sharing some of the detail on that and in how it would work should the coalition win government. They were essentially proposing to start by indexing the two lowest tax brackets in 2028-29 with the top two tax brackets to follow in 2031-2032. So those two lowest ones being the tax-free threshold, which I think is 0% on up to 18,200.
200, yep.
Yeah, and then the other one, which is the
45,000.
Currently 16%, but going down to 15% next financial year, and then 14% the previous the following financial year. Those two ones will be indexed to inflation in 28-29. Will be under their plan, those top two ones following in 2031-2032. So, Angus said this would see the typical taxpayer keep an extra $250 in their pocket in the first year, and up to $1,000 annually by the fourth year. Not to mention the government foregoing around $22.5 billion in tax, which is where the current government is criticising the government, saying, okay, the opposition saying, well, where are you gonna find the money to afford such a thing? What sort of cutbacks are you gonna have to make? But yeah, it's I was going to say I hate to mention. I actually love to mention it because I asked Angus Taylor on the podcast.
I knew you were going to say this. I knew it.
Come on, we couldn't let this one slip by. He was, in his back when he was Shadow Treasurer, we had him on the podcast, and I asked him about it. I said, hey, seems like an obvious one to me. Why don't you index the tax brackets to inflation? Particularly that tax-free threshold, which if it had been allowed to adjust with inflation, it would be $50,000. It wouldn't be $18,200, which has been stuck at for like 12 years or something.
I think it's 12 years, yeah.
And he sort of, his whole line generally was, we need to focus on getting inflation down first, blah, 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 blah. Then, after we sort out inflation, then we can look at things like, income tax brackets or income tax cuts. But it turns out, I've just been doing some reading, and it turns out he actually was keen to go into that last election with that policy, but it was Peter Dutton who was opposed to it, saying, no, it's going to be too costly. Very curious to know how they would have gone in that last election had they had that been their policy. So I do wonder, did I plant the seed? But no, I'm sure a lot of people have been asking Angus about that. But it's something that listeners probably can tell that I agree with. I think it is fair for taxpayers that that the tax brackets do go, that you're not essentially having to pay more tax because of inflation. Governments then, it reduces the incentive for government. Well, it increases the incentive for governments to tackle inflation because, in a way, they can just sort of, some governments might benefit from inflation because it's like, we can just let inflation go on a bit and we'll get more tax revenue that way.
That's exactly right. And it's often suggested by economists. There's, they do quite well out of tax when inflation's quite high. If they did have an incentive. They don't admit it.
Yeah, but they don't mind a little bit of inflation. It's a bit of like easy budget repair.
It is.
It's too hard when they do actually need to raise taxes. It's very hard politically to actually increase the tax rates. If you want to win government in the next election. So it's a tricky one. I mean, as Professor Peter Swan in last week's episode said, the Fraser government did temporarily, and I think you mentioned it too, back in the late 70s, early 80s.
76 to, I think just it might have been 1982 when
something like that.
The inflation rate was 11% and they needed more money and they said,
They had to remove it.
we'll let that one slide and see if anyone notices. So it's it's an unlegislated thing, as you said. It's it's a sneaky way to get more revenue without telling anyone about it. Basically,
bracket creep is the word. Yeah,
bracket creep
so
is
eliminate bracket
you've
creep.
probably heard that term, and getting rid of bracket creep, putting money in our pocket instead of the government's. That's why it hardly ever happens.
Mm-hmm. Now that was the big highlight coming out of that budget and reply speech, but. Some of the other stuff was obviously they were repealing all of the government's changes to property taxes and capital gains tax and negative gearing and so on and so forth. Inheritance, what do they call it? Trust discretionary trust taxes, even the minimum 30% tax. All of that he's basically saying no to.
Thrown away, yep.
And I'm sure there are a bunch of other stuff, but I don't think we have time to get into all the others. So let's
go there. We won't go.
Savings account rate changes following the RBA hike. Denise, what have you seen?
Yes, I have been diligently tracking those. So if you go to the Savings.com.au page, you'll be able to just see whether your bank has moved their rates this time around. Even today, there's a few banks that have made some announcements, mainly the smaller ones. Now, the big four, the big five, if you count Macquarie, I think the ANZ was the last to announce its rate changes on Friday of last week. So they've all announced their changes. Pretty much we've seen as we expect to see, and we've seen in previous rate hikes, most of their, the 25%, 0.25%, increase in the cash rate gets passed on either to an introductory rate, a bonus rate. Very rarely do we see base rates receive a full, cash rate increase. That trend has continued. Macquarie, of course, they have one savings account product, and that just goes on to they have an introductory rate for that, but they also increase their ongoing rate. So, the trend is continuing, and it's quite interesting because, Dom, you were approached by none other than the Financial Review this week to reveal your thoughts on banks passing on savings account interest rates. So from the horse's mouth, what did you have to say in your expert opinion on that?
Ooh, thanks for that plug, Denise. It was nice that we were getting approached by the likes of the AFI to talk about that. But essentially, I was just sort of saying in the papers that what you've just pointed out there, the banks, maybe on at the headline, it sounds like they're passing them on to. Passing on the hikes in full to savings accounts. But if you do look into it in detail, you'll see that they're rarely passing it on in full to the base rate on their savings accounts, which means, sometimes it's wholly passed on to just the intro rate, or sometimes just partially passed on to the base rate. Or just passed on to the bonus rate. So that means a lot of people will miss out if they're either, not still within that introductory period, or they're not meeting the bonus rate conditions each month. So we've seen the big four banks have all confirmed their rate changes for this month following this most recent RBA hike. And I don't think any of them, correct me if I'm wrong, I don't think any of them are passing it on in full to the base rate. So if you're going to be fair to all your customers, you pass it on to the base rate. That way everyone benefits from the savings account rate hike. But that's just not being the case at the moment. So it is disappointing to see. But I think as well, we're in in this globalized environment we're in. These banks actually can get away with offering lower deposit rates because they don't actually get all their funding or as much of their funding, or depends so much rather of their funding on customer deposits, because they can get funding from around the world, from overseas markets. Like Japan actually are big funders of Aussie banks. They've got famously very low interest rates over there. I think that their cash rate was actually negative until quite recently. Or maybe it still is, if I might be mistaken there. But so they just chasing some return. They're happy to put their money into banks, so these banks can fund their mortgages that way, right, via overseas bond issuances and things like that. So in a way, I think they can actually get away with offering worse deals for savers. So it's a bit disappointing to see, because if you look at back when the cash rate was at a similar level, many years ago, you'll see that the average savings account rate was higher than it is now, despite the cash rate being about the same. So, that's a bit of what's going on. That's the way it is. But the way, there's still better banks out there, better savings account deals. So, vote with your feet and try and get that as high a rate as you can. All right. And we'll probably just jump into the next story item here, just because we're running out of time. The RBA has released the minutes from its 5th of May meeting yesterday and revealed the board sees room to possibly avoid a 4th consecutive rate hike next month, despite both rising inflation and slowing economic growth, given the ongoing situation in the Middle East. So the minutes showed the board agreed that monetary policy could not alter the near-term trajectory of inflation. And CommBank economists say the cash rate will, it sort of reaffirms in their mind that the cash rate will remain on hold at 4.35% for the rest of this year, while ANZ sees it staying at the current level for a prolonged period. So I'm not sure exactly what that means. And meanwhile, I've seen the odds of there being a rate hike next month have fallen to 9%. So only less than 1 in 10 chance, according to the markets, of there being a rate hike next month, which is some relief. But as you're aware, Denise, I think Westpac still believes there'll be a hike in August.
Yes, I think they're the only bank of the big four that is believing. I think earlier this month they said August and September. It'll be interesting to see what happens. It sounds like June we may just get a little bit of a break there. And I guess, as Michelle Bullock said with the last, rate announcement earlier this month, it gave the board some breathing room, the May hike. So I guess that's the wait and see what happens in the Middle East and how things play out. A lot of this will be driven by higher oil prices. The Middle East conflict continues on. Let's see. Let's just see where it all ends up. But I think they are expecting inflation to be around the 5% mark towards the middle of this year. It's not where we want inflation to be.
Yeah, indeed. Yeah, time will tell. But it would be some relief to not get a 4th rate hike in a row. But that's obviously not guaranteed. All right, I think that wraps up the main money matters of the week. So time for Dollar Dialogue. Okay, now for this week's Dollar Dialogue, we're speaking more on some of the contentious tax changes raised out of last week's federal budget, and someone that has some serious concerns about how the reforms to capital gains tax could impact younger savers and investors is federal independent MP Nicolette Boele, who joins us now. G'day, Nicolette. Welcome to the Savings Tip Jar.
Thank you for having me, Don and Denise.
Great to have you. And before we start, we're going to do the traditional thing and ask you, Nicolette, for your savings tip.
Yeah, I can't not do this because of my background in energy and finance, and it's a savings tip around energy. So the Australian Energy Market Commission introduced something called the Best Offer. What that means, every quarter on your energy bill, energy retailers have to tell you what the best offer plan is. And people have written into me and said, thank you for letting us know this tip, because people are actually saving, upward of $150 a quarter just by switching plans from within one retailer.
Wow.
I did not know that.
Yeah, I was going to admit that I wasn't totally aware of that one either. So that's something I will probably look into for my own personal situation at the moment, because those energy bills are certainly really starting to bite at the moment. So that's a great one. We haven't heard that one on the pod before. Thanks, Nicolette. Getting into the nitty gritty. First up, the federal budget has been sold as making changes in the interests of intergenerational fairness. Is that how you see it?
Well, yes and no. I want to say that it is pleasing to see that in the second term, in its second year, with a large majority, the government's giving something a big, hard go that I think most parliamentarians and politicians run scared at, and that's tax reform. But I have to say, after surveying our community around capital gains tax, would they welcome a change, particularly to try and level the playing field so that, first home buyers aren't, I suppose, unfairly advantaged when they go to an auction and they're competing against property investors, for example. There was a huge 2/3 of people supported changes to level that playing field. Another 11% said they'd be open to it, as long as it's in the context of broader tax reform. But what we saw in the budget last week, it just felt like it didn't feel like something that was targeted at housing only. When we've got these CGT changes that go right across all the asset classes, and I'm someone sincerely committed to improving productivity in our economy, I got to ask, why create all these headwinds for small business and startups and even renewable energy infrastructure when, if it isn't intergenerational equity, if we're genuinely trying to get young people into homes, we need a really productive, vibrant economy at the same time. So it's a yes and a no. I think the execution around this has a lot to be desired.
Okay, so what is it then that you would like to see changed out of what we've heard from the federal government so far?
I think my community, who is writing into me every hour, I'm getting this is Sydney's North Shore. It's quite an economically good place to live, if you like. We're very outward looking, but people want their kids to be able to afford places here in the community where they grew up. It's a great place to raise your kids in fantastic schools, aged care facilities and hospitals and whatever. I think if we can ring fence the CGT changes around property, I think you'd get, there's some winners and losers, but broad support. But we need to just take a deep breath and let's have a look at, let's consult, and let's put those impacted people around the other changes on asset classes, like young people who are using exchange-traded funds to save because they can't save up enough. They're young. You want to take risks. You're not going to put your money into a 2-year bond right now. You want to put some of that into stocks, take some risks. Those people need to be consulted. The Treasury needs to do some modelling. And if it really is such a good idea to pull back the discounts on CGT for these other asset classes, then why doesn't the government take that to the next election and get a mandate to do it?
Yeah, absolutely. And that's something that, like, a lot of younger savers, we were constantly told you have to do the right thing. You need to save and you need to invest your spare funds. It's while you're young is one of the best times to do it. You've got more time on your side to ride out the ups and downs. It's not like you're just before retirement. And yet I think that's why younger people in particular, are taken quite aback by these changes, because I think they were happy to see them applied to housing, but seeing it applied to things like shares and even small businesses, that is certainly hurting them at the moment. But you mentioned that the giving people the opportunity to give the government a mandate. That was actually something I was going to ask you about, this sort of question of integrity here, because the government essentially broke its promise to not make any property tax changes. And I just think that if you are going to go against your word, at least propose the legislation just before an election so that, like I said, you're giving the public an opportunity to mandate those changes. So, can you just expand on that?
I don't disagree with you. On one hand, sadly, I think most people don't expect parliamentarians or politicians to keep promises. That's not unfortunately, that's not a thing. And it does take guts to say, hey, I was wrong. And maybe the situation or the environment's changed and we have to be nimble and change. But the fact that we have rising inequality, that young people can't get into homes, is not something that happened overnight. This has been going on for decades and decades. It's the red and the blue team over many successive governments that have failed to understand just how important to our whole economy and to, frankly, future generations that we give people the opportunity for secure shelter. Just how important that is to get a home so that you can have a shower before going for a job interview, get your job, have income, raise a family if you want, put them in a local school. Like, that's not nothing. That is the backbone of what it means to be, have a meaningful contribution to life. And yet for so many young people, it's so far away. And so I am pleased that on this occasion, they've had, frankly, the backbone to take on this issue around the inequity between first home buyers and probably property investors. But by and large, this government isn't the best at communicating. I feel like they haven't done the appropriate consultation to bring people along on it. I don't even think some of these things have been, frankly, modelled by Treasury. So this is the opposite of how you get tax reform and bring people along. And I think they've got a lot more work to do to get this right.
So, okay, let's just say housing is going to stay as it is. Do you really think there's much of a chance, or do you see this government sort of watering down or being prepared to, nibble around the edges and consult with people to have some changes of what they've announced? Is this a feasible thing?
Yeah, at least what I've heard so far, which also goes to the fact that if they'd consulted properly, they wouldn't be sort of flip-flopping here. But I have heard within 24 hours after the budget, that they are willing to consult with startups about the impact on that particular, asset group. Because, there's a lot of sweat and tears that's taken in equity there in terms of stocks and stuff that are held for a long time and not realised for sometimes decades. You just can't throw a capital gains tax change to that because it doesn't back the small businesses and those innovative companies that we want on the world stage proudly as Australians. There's tech companies, there's medical research, there's a whole lot of those. So the fact that they're engaging on that says that they are willing to do that. There's another niche area around changing the capital gains tax on international investors in things like renewable energy infrastructure. 3/4 of the money that goes into big-scale solar farms, for example, comes from overseas, particularly from pension funds. And they want to not only change the future CGT treatment, but they also want to backdate it like 10, 20 years. That's like the opposite way that you attract investment into our country. So the fact that they are pausing on that and engaging, unfortunately, after the announcement, tells me that, yes, they are willing to try and get it right. But who knows? I go back to Canberra next week with 149 other people in the greenhouse. We'll see what happens, and it's got to go through the Senate. I imagine there'll be many changes. There aren't that many people who wholeheartedly love it, and I really do hope that the changes to the housing make it through, but it's going to take a lot more changes to have my support as it is.
Yeah, certainly there were a lot of concerns that the impact on people who that in that startup culture would send a lot of our best and brightest overseas, and we want people innovating, want people taking risks and putting their capital towards starting up a business. But like sort of we've discussed, it's younger people tend to embrace risk a bit more, particularly when it comes to investing. And some people have said that these capital gains tax changes, for some people who are investing in maybe lower risk assets that have like higher dividend yields, the indexation to inflation method might actually result in less capital gains tax overall. But younger people that might invest in those riskier assets that maybe don't pay out big dividends and they're more chasing those big capital gains, they will be hit quite substantially by this sort of thing.
That's exactly right.
Is this the government effectively saying don't take risks with your money to people?
That's a really interesting way of putting it. I think the fact that it's taken a dual path to how you can opt to tax, with the indexation but it's still ultimately a 30% minimum tax. So in some respects, yeah, it does. And I think that goes to where I think the government's missed this. It allegedly has tried to fix something around housing affordability and that intergenerational inequality, the fundamental aspect of giving people, reliable shelter for the whole economy to work. But on the other hand, they've just got this blind eye to all of those other assets that are hugely productive and contribute to our tax base as well in the future. And they just want to have this headwind for people to, as you've pointed out, Don, to get in and take risks and take a go at starting a business, or in the case for young people where it's actually prudent that you do take. You always want to have a broad range of investments. I mean, get your own financial advice, everyone. But you want to diversify your portfolios. But when you're young, you should be taking, have higher risk sort of scenario. And you can't lock up a lot of your money if you do want to step into at any point. I had a 33-year-old wrote into me just this morning who said she's like ready, thinks she's ready to maybe try and go and bid on a place now. She's been using ETFs for a good part of a decade. And the reason she's done it is she couldn't afford to lock that up in a government or a corporate bond in case she found the place that she needed. So will she, if she's been doing 10 years, what's her capital gain going to look like? It's been a bit sluggy the last little few years, but before that, there's been, depending on where you're invested, she's going to be hit big time. So her ability to borrow when she finds that house will be diminished because her savings and her deposit will be less. I mean, fast forward 2 years if that were the case. So I think, yes, it doesn't feel like it's engendering an appetite for competition, productivity. It feels like it's putting a handbrake on those productive assets. I don't think it's done it intentionally, but that goes right down to a crappy process where they just needed to have done the homework before they came out and announced the changes.
Yes, it did sound as though it seemed last minute, and they've even said publicly, both Jim Chalmers and Anthony Albanese, that the housing stuff at least was a last minute call. So you probably got some substance to your view on that. So I guess now it's over to Canberra, and we wait and see what happens when everyone goes back.
But I got to say on this one, and I know it's not housing, but if we just taxed our gas exports at 25%, and they brought that in 2022 when that red team took over, we would have $70 billion to probably help young Australians get into homes. So I'm just saying, on one side, we're looking at making all these changes, but they have missed out on so many low-hanging opportunities to raise more money from, giving us a fair share of what are our finite resources. I think that's a real missed opportunity.
Yeah, it certainly seems that judging by the reactions we've seen across the political spectrum, a lot of people are not too happy and quite dissatisfied with this budget. But, as you said, sort of at the start, this government has got a big mandate, given their substantial majority to make some significant changes. And if they are going to make changes, you'd think now would be the time to do it. But at the same time, I do still think it's a bit unfair that they didn't propose some of these major changes just before an election so that you can essentially get the permission of the people to go against your own word. Nicolette, Boele, really appreciate your time on the Savings Tip Jar podcast. Thanks very much for your insights.
Thanks. Great to talk to the savers.
Thank you.
That was Federal Independent MP Nicolette Boele, and that brings us to the end of another episode of the Savings Tip Jar podcast. Thanks very much for listening. Thanks, of course, to our sponsor, Savings.com.au. Thanks, of course, to our guest, Nicolette Boele. Thank you to my co-host, Denise, and thank you very much for listening. If you enjoyed this episode or you just enjoy the podcast in general, please give us a 5-star rating on Spotify, Apple, or wherever you get the podcasts. It really makes a difference. If you want to hit us up, please send us an email. We love hearing from you. Inquiries@savings.com.au. That's inquiries with an E. You can also follow savings.com.au on Facebook, Instagram, TikTok, LinkedIn. I think that's most of the main ones. I've got a YouTube channel too. So yeah, you know where to find us. Thanks very much for listening. Catch you next week. Goodbye.